The steady rise of gold and silver prices has been ignored by the mainstream media. In great detail, we noted that there was barely a major article about gold soaring prices. We go back from September 9th. We could go back further, but we just showed you from there to last week. Yep. September 23rd. On Friday, gold prices went up 1.1%. That's a pretty big jump, right? Should have been news? No. Gold drifts higher with a spotlight on Fed policy path. Drifts higher? That was CNBC. Yep. How about gold prices spiked? One after another. We go down the list. And hardly a word. They don't want to talk about it. Now, here's what's very important that no one else is speaking about. What they keep saying is gold prices are now going up the fastest since the late 1970s. This is a different story. Back in the 1970s, oh, by the way, this is Bloomberg. Go to Bloomberg and zip zero headline about spiking gold prices. And we say nothing about gold in their latest report for 4 hours. We looked at it. Both were touting the stock market's rebound. As Bloomberg wrote, stocks rise as Powell keeps Fed cut wagers in play. Yep. And CNBC, Fed's Powell suggesting tightening program could end soon, offers no guidance on rates. Oh, by the way, Goldman Sachs, a while ago, they said gold in 2026 will hit around 4,400. Now they're saying break $5,000 an ounce. That's Goldman Sachs. That's the banksters saying that. So again, they don't go back. You don't go back to the 1970s. Back then, America, we're number one. Oh, remember, we used to be the exceptionals. Yeah, those days are gone. It's a different world. Back in 1978, when gold prices started to spike, America's gross domestic product was around $2.5 trillion. China, today's number 2 largest economy in the world, back then, before a rotten piece of crap, a warmongering prick who brought China into the World Trade Organization, took our jobs out, NAFTA. Oh yeah, before Slick Willie Clinton did that, that was a t-shirt I did in 1992, just to tell you the way I feel about this shit. You ready? Again, America's gross domestic product was around 2.5 trillion, while third world China's was 150 billion. 150 billion. Today it's 20 trillion. All right. India, back then, these are countries of 1.4 billion people. Now, 137 billion. Today, 4 trillion. It's a different game. There were no BRICS back then. The world is fighting against the United States economic hegemony. Gold is telling the story, and we're telling it. There are others that are telling it out there, but no magazine is telling it like we are. So this is very important to watch. And seeing trouble ahead today, Trump blamed the BRICS for, quote, their attack on the dollar and their attempt to weaken its status as the world's currency. So again, there's no relationship between rising gold prices back in the 1970s compared to today. And again, you know one of our trends, prepare for the death of the dollar. It's going to happen. The debt level in the United States is not, what I said, what they might do, you remember, hey, Trump said, hey, me and Musk were going to go into Fort Knox. We're going to see the gold we got. They got sold. How come you haven't gone in there? And they know what's in there. That's bullshit. We're going to go in there. They know what's in there. So there may be a possibility that they may increase the value of gold, double it, more than double it. So they say, we got all this gold. We don't have any debt problem. Gold's covering us. So that's some of what you got in your Trends Journal. But of course, there's a lot more.
So what are the similarities and differences between that gold trade and what we're seeing with the S&P 500?
Yeah, absolutely. So gold's always traditionally been viewed as a safe haven for economic turmoil, geopolitical instability, things that we're seeing right now, because it doesn't have a yield. Generally, falling interest rates are beneficial toward gold. That's when we see a lot of investors start to move into gold. So far this year, we've seen on physical gold exchange-traded products about $38 billion of investor flows going in. What's really happening now is a shift into the acceptance of gold. Typically, it's been viewed as kind of a fringe or outside metal and allocation tool. What we're really starting to see is now more prominent economists are starting to shift or suggests shifting from a 60-40 model to something closer to a 60-20-20, where it's 60% equities, 20% fixed income, 20% gold. Most people, we feel, are probably well positioned if they have about a 5 to 15% allocation of physical gold, depending on their risk tolerance. What you get out of gold is that hedging to the broader investor universe. So when you start thinking about things of correlations, well, how well does gold move versus other aspects of the economy? We tend to see low to moderate correlations across most major asset classes and an inverse correlation to the US dollar. All aspects of the economy that investors are starting to feel uneasy about at the moment.
Does that make you feel as though, Steve, does that make you feel as though there is going to be a continued bid for gold, given the fact that, at least for the medium to longer term trend that we've seen so far, there is a decline in the value of the US dollar relative to other developed market currencies? We are continuing to see some geopolitical risk. The Middle East peace progress aside that we've seen, there are aspects of, say, a government shutdown that we are currently still in, political risks in the U.S., geopolitical outside, the dollar and everything else. Does that mean gold does have a clear path forward to the upside or not?
We do think there's still significant room for gold to run. I think today's a great view on that. We see the deal in the Middle East that hopefully can relay tensions down a little bit. Gold's higher this morning, over $4,100 an ounce as we're sitting here. We're seeing, discussions about potential reciprocal tariffs and, as it relates to rare earth export restrictions coming out of China and what that might do to elevate an already tenuous geopolitical realm that we have with China. That's pushing gold prices higher. I don't think those overlaying macro factors are going away anytime soon, and I think that's something that investors are really latching onto. Another aspect I think that's really important to gold is that a lot of central bank buying is happening in the metal. So that's really pushing prices higher. Over the last 3 years, it's been about 1,000 tons per year. We're still seeing continued buying from central banks. What that does is allow central banks to de-dollarize their assets. They can move out of treasuries, move into gold, and at the same time, they can actually repatriate that gold back to their home countries for their own self-storage. It gets it out of the way of sanctions that could potentially come from the United States or other. Several ways to get access to gold and silver, for that matter. Typically, what we see is that investors tend to be underallocated to gold, below that 5% allocation that we typically see from investors that have a significant portion in their portfolio. As it relates to gold and silver, there are other options where you can kind of get some outsized returns by investing directly in the mining equities. So gold miners, silver miners, they have operational leverage to the underlying price of gold or silver, which typically allows them to outperform over longer periods of time in bull markets. We're coming on to a period now where if you look at the top performing ETFs in the US, 12 out of the 13 best performers are gold and silver miners. So they're far exceeding what we're seeing from the physical metals themselves.